Well, hi everyone, and welcome to our bi-weekly call. And thank you very much for joining us. I see we have quite a few people already, which is great to see, and we have quite a few questions already. If you are going to share this via social media, now would be a good time to do it. Just say, we're going live, and then perhaps people will join us. That would be great. The more people we have, the better. And thank you for the questions already. That's incredible. You've got so many. So I thought maybe I'd start off just by talking a little bit about where we are with markets at the moment. There's been some interesting market moves. We have seen a bit of a jittery market over the last couple of weeks. I put out a video which was trying to calm people down because I think it's very easy to overreact when things start to sell off, particularly since we've had such a very strong run for markets. And when that happens, people aren't used to markets falling 5%, which is what pretty much happened for the S&P. But it really isn't a big sell-off yet, so I really wouldn't panic. And even if it does become a big sell-off, remember that's a buying opportunity, not a selling opportunity. Just keep your head cool, have a plan, and if you have a plan, stick to it. Don't kind of panic, because that's the worst thing you can possibly do. So let me just share my screen. There's an interesting story about what happened today, in fact, in the FT. Let me just share my screen. So this is an article that is in the FT, and you can see that Jerome Powell was speaking today, and what he said was that the Fed would remain accommodative, they'd keep rates low, they keep QE in train, even if inflation rises above 2%. Of course, there's nothing new here. Powell will have been really careful about the messaging. He's not the kind of guy to make a mistake or misspeak about monetary policy. That would never happen. But I think what it shows is that markets are really jittery. But the point is that after he said about being patient, withdrawing support for the recovery, look what happened to Treasury yields. So this is the yield on the 10-year government bond in the US. And over the space of a few minutes, it went from about 1.47% to 1.54%. And this is kind of like the spike we had a few days ago, which also spooked equity markets, where yields jumped to 1.6 over a very short period of time when there was a low demand for a 7-year government bond, which had just been auctioned. So this is, I think it's more a sign that that people are scared that we have reactions like this. Another thing that's interesting to look at is actual inflation expectations. So if you look at the 5-year forward inflation rate, so that's expectations about inflation 5 years from now, and then looking forward 5 years from that point. So it's looking from 5 years forward to 10 years forward. The inflation expectations are currently around 1.97%. Now bear in mind the Fed's target rate's 2%, and these have actually fallen from a peak about on February the 8th of about 2.14%. So inflation expectations are using this range of maturities are actually falling. So that's kind of contrary to the narrative that inflation's expected to spike up massively. And that's, of course, a market implied measure of inflation. And if we look at actual inflation in the US, that's extremely muted since this recession's been going. So 1.40%. So I'd recommend that you read some articles by Claudia Sahm, the lady who created the Sahm rule. She's Macro Mom is her blog, used to be, but she started moving to Substack, I think. But she's just written an article, you can find it on Twitter, where she's talking about why she doesn't expect inflation. And she kind of goes through the arguments made by Larry Summers, and I think does a fairly good job of showing that there's a fairly good case to be made that there won't be huge inflation from where we are now. I guess one of the things that does make people think inflation will spike is if you look at the savings rate, so that's the proportion of income which is saved by people in the US. Historically, it's been at around 10% up to about 1985. Then it fell to very low levels around the global financial crisis. It rose again a bit to about 7 or 8%. But just look at what's happened since the pandemic. If we zoom in, we had this massive spike to 34%. I don't think it's ever been as high. Then it fell again, but recently on the last two prints, it's gone up to about 20.5%. So if people are saving, then that money has to go somewhere. And I assume that it's going to go into, well, some of it at least is going to go into equity markets. But again, there could be greater activity. People could go out and spend on consumer discretionary spending, and that might be an inflationary force in the months ahead as markets as people kind of venture out into normal life again. But if we look at the break-even rate, the kind of 10-year break-even rate, that's around 2.2%. So overall, I don't think there's a really strong case to be made that we're going to have a massive inflation spike. Oh, that's interesting. So personally, I just don't buy that. But that, I think, is what spooked markets. But again, I think this is just a sign that markets are so kind of on edge at the moment that the slightest comment from a very careful Fed chairman would spook markets. Okay, so let's go to the comments. Remember that we're going to be on until 8 o'clock. We will give preference to people who support us on YouTube. So our YouTube supporters will get pushed to the front of the queue in terms of questions. And also, if you ask a super chat, so you have to pay for that, then you will get pushed to the front of the queue to have your question answered. So just bear that in mind. Right, so please like this. Please like it. That would be great if you just touch the thumbs up button, ring the bell. That would help us a lot. Great. So we only have 56 likes at the moment, but 300 viewers. So only 1 in 6 of you have liked it. So please do like it. It makes a big difference to us, and it's very easy for you. Right, so questions. Here we go. Right, so we've got one here from Laura. Okay, so Peter Simcoe says minimum pension contributions increased in the last years in the UK and also in some of the EU countries. Doesn't this inflate share prices as well? And how much to compare to government easing? Certainly this will, I mean, if you are forcing people to put more into their pension, of course, it creates more inflows into the equity market. But the question is, what percentage increase inflow does that create? So if it's a very large change, yeah, it would have a big effect on markets. But remember that markets are fairly deep and liquid. So how much of an effect it'll make? Not a lot, I suspect. Particularly as a lot of pension money is invested globally. So just one country increasing flows, unless it was the US, which does have a lot of capital, probably won't have a massive impact. Maybe on the domestic market if it's a small one. You know, so if you're from the Netherlands, for example, if they put money into the domestic market, that could have a fairly large effect. But if you consider the US, I suspect the effect won't be huge. To answer your question, just see if I answered it properly. Yeah. Okay, I'll start answering questions from. Oh, there's a comment from David Kirk. That's nice to see. David Kirk, I think, has just supported us. He just joined us, so thank you, David, for joining our YouTube membership. Peter Simcoe says, oh, that was his question, which I answered. Antonis Damianou says, I haven't started investing yet. I have a decent amount of cash and want to invest in global equity fund for 30 plus years. That's great. Should I wait for a correction and lump sum or start now with dollar cost averaging? So obviously, Antonis, I get asked this question a lot, particularly at the moment. And if you are going to be investing for a long period of time, historically, the benefit of not putting money into the market because you think there's going to be a crash is limited. In other words, you can't time market crashes. It's unfortunate, really. If there had been a market crash at that point, you could say that, yeah, equities are now cheap and now's a good time to heavily move into markets. And it's a lot harder if you've got a lump sum, because then you do have to decide whether you drip feed or whether you put a large amount in. All I'd say is it's usually best to put it in straight away. If you are nervous about a sell-off, then drip feeding is a way of ensuring that you do get exposure to equity, even though it's difficult and you feel as if equity markets are overvalued. It's kind of like being a Marine, right? Marines are trained to run into enemy gunfire. And that's what it feels like. When equities are volatile, as they are now, and valuations are very high, it is like running into enemy gunfire, allocating capital into equity markets. But it's a difficulty which you have to overcome somehow. So drip feeding is a good way to ensure you have that discipline. And you could always say, I'm going to drip feed over 2 years. If equity markets do correct by, say, 30%, I'll accelerate my move into markets, equity markets, at those more reasonable prices. So perhaps that's the way to do it. Right, next question. And Jimmy says, thank you, Jimmy, Ramin has a video on lump sum versus dollar cost averaging. Yeah, so that might be interesting. Also, I did a video recently on rebalancing, and that was actually looking at whether you can use Robert Shiller's new valuation measure to decide whether to hold back money from equity markets. And to cut a long story short, you can't do it. Even if equity markets are expensive, it's still usually better to just carry on investing as soon as possible, assuming that you're drip feeding into markets month by month. That isn't for a lump sum. That's just assuming you drip feed or hold back your drips when markets are expensive in bonds, and then as soon as markets fall below a threshold cheapness, you pile into the equity market and you take all of your bonds and sell them. And that just didn't work. You can't really do that using enhanced CAPE yield, excess CAPE yield, which is Robert Shiller's new valuation measure. Right, next question.
There's a member question.
Oh, there's a member question. Praveen Desai says, Nasdaq is now 10% below its highs. How low can it go? So let's have a look. Let's have a look at the Nasdaq. So yeah, it might be worth mentioning this as well while we're here. So let me just share this so you can see. Right, so this is the this is all the holdings, almost all of the holdings of ARK-K. And if you look at the change over the last week, only one of those shares, which is Tencent Holdings, the Chinese stock, is positive. Everything else is negative over the last week, and some of it by huge amounts. So for example, if we look at CRISPR Therapeutics, that's down hugely over the last week. It's down 13%. Some of them are down 30%. So really, for all of these growth stocks, it's been a terrible sell-off that we've seen. So in the QQQ obviously is one that's suffered as well. So there we go, there's QQQ. And although it's been an incredible run since that March sell-off, it's still up by 26.7% since where it was in February last year before the sell-off. It's down now 10% from its peak 2 weeks ago. So that does look fairly chunky. Obviously, markets are spooked by rising yields, and what gets affected most is growth stocks because they have greater sensitivity to interest rates. So yeah, that is pretty scary if you're a QQQ investor. The question about how low it can go, well, I guess you could say February was 230. So if we went back to where we were in February, that would be a 30% fall. It really depends on how spooked markets get by these increasing yields. Personally, I don't think this is going to be a massive sell-off, simply because there is the support from the Fed. There's the massive fiscal stimulus in the US, We have a lot of savings in the sidelines from, as we saw with the savings rate when I first started this session, we saw the savings rate has gone up again. So all of that paints a fairly positive picture. We still have low interest rates from the Fed. So personally, I don't think this is going to be a massive sell-off, but you can never tell. You can never tell. And I don't think there is any way to put a kind of bottom on where the Nasdaq is going to go. What you can do is look at valuation. So look at where valuation has been typically over the last 2 or 3 years. Look at the forward PE of the Nasdaq, and then you'll know when it's cheap. And once it hits fair value, you know that's a good time to buy. Even if it falls further, it doesn't matter because you know you've bought it at a reasonable price relative to earnings. And that's the beauty of equity. You can have these measures which tell you when it's reasonably priced. So use that information if you can. Yeah, what were you about to say, Laura?
The super chat.
Okay.
Ask people to like.
Oh yes, please like.
And there's 2 member questions.
Please like our stream because obviously it helps us. More people see it if you like it. And we have a super chat. All very exciting. Here we go. iTurtle HD. I don't think we've met before. Hi Ramin, love your videos. Thank you. Can you explain how a fund manager decides which bonds go into a fund? E.g., Vanguard's Global Bond Index Fund. Sure. Okay, well usually, if it's a passive fund, it'll track an index. So for example, the Global Bond Index Fund will probably track the Global Aggregate Bond Index, which is maintained. It used to be maintained by Lehman, of course, it's not anymore. It's maintained by Barclays and Bloomberg. I suspect it's Barclays that does the calculation. But the way they decide which bonds to buy is it has to satisfy certain criteria. So liquidity will be a criterion. If it's going by country, then it'll find the most liquid bonds within a certain category, so government bonds, for example, or corporate bonds issued by that country where the amount issued is largest. Because what you don't want is to buy small illiquid issues because the bid offer spread on those is very large. And then when the fund manager has to recreate the index by buying the bonds, they're continually having to buy and sell, and the expense of doing that is higher. So liquidity is a big issue for these indices. So let's say it's a corporate bond index. It'll have some kind of rating criterion. So if it's investment grade, they won't be able to buy any bonds which are below triple B. If it's a certain currency, obviously you can only get bonds issued in that currency. Perhaps it's also sector based, in which case you can only buy bonds from a certain sector. So that's how it generally works. And for the global bond index, it's dominated by US bonds because they're a bigger market. And it also has some agency securities in it. So things like mortgage-backed securities. That's a massive US market where they take US mortgages, they bundle them up inside a bond. They put a stamp of approval from the government, which makes it AAA, and that's your MBS. And that's a big market, and a big chunk of that global bond index will have that in it too. So you can see it's not a simple process to actually create these indices or to track them, but that's how it works. So please do like our stream. Currently we've got 200 likes and 500 viewers, so surely more than half of you like the stream. That would be great if you did that. Remember, you can always do a one-to-one power hour with me if you want a one-to-one. If you want a one-to-one like this with me, but just the two of us, that is a popular choice by many people. Also, you can join by supporting us on YouTube. There's just a join button, which you'll see on any of our videos and underneath this stream. Just click on that and you can become one of our supporters, and then we'll see the little crown by your name and you get pushed to the front of the queue when you ask questions. So
and therefore, in your Slack channel right now.
There are 4 in my Slack channel right now which I haven't answered. Thank you, Laura. Okay. So, okay, number one. Carla Hernandez says, how long does a market correction last? It depends on various things. I mean, so for example, let's go back and actually just look at the S&P. That's probably the best way of looking at that. So let me just get the S&P up here, and I'll share my screen with you so that you can see this. One moment. There we go. So here is the S&P. So let's go back as far as we can. So there's Nasdaq. No, we want the S&P. Here we go. So this is the S&P going back to 1962. We're going to put it on a log plot so that you can actually see the lumps and bumps. Now, if we go back, you can see that there are various drawdowns here. How long do they last? Well, you can see this one in 1973 lasted to 1975. So that was a 2-year period from peak to trough. But then it didn't recover until 1981. So that was a decade drawdown. Then we had a shorter drawdown here from 1981 to about 1983. Here's another one. But my point is that you could panic about these drawdowns, or if you want a really simple approach to investing, you just buy and leave it, because eventually it recovers. It may take 10 years, sometimes it does. So for example, after 2000, we had the dot-com bubble, the S&P dropped 45%. It had almost recovered to where it was. In fact, it just got beyond where it was in 2000. And then we had the global financial crisis, bam, another 50% fall. And then it didn't recover until 2013. So you could say there was a 13-year period for the S&P. And if you inflation adjusted, it's probably even worse, where it was underwater. But remember, usually what happens is you're drip feeding money in. So you're buying all the way down. You're buying on the way up. You're buying on the way down. So it's actually to your benefit in the long run that markets do fall. This is a feature, not a bug, that markets crash, because it lets you buy at a lower valuation. And over the long term, that gives you a better return. If you buy at high valuations, generally, returns aren't as good. It's fairly obviously the case, right? So how long will it last? We don't know. But it could be a decade. But should you panic about it? No. Not unless you're investing a massive lump sum, would you worry. If you're going to be drip feeding, it doesn't matter. It means you can buy more cheaply. It's all I'd say. Okay, back to the questions. And here we go. So the next question is from Dag Helga Gunderson, who says, what's the reason behind the bad performance for Chinese stocks lately? Okay, so let's look at one of those Chinese indices. So let's look at the CSI 300. So let me just share my screen so you can see this. And here we go. So this is the CSI 300, which is the Shanghai CSI 300, the composite index. And actually, it hasn't sold off too much. So if you look since 2019, it's been on a fairly good rally. If we look at the fall since the peak, which is a few days ago, it's not huge. If we zoom in, we'll see how big it is. You know, that's not really a huge fall. It's 6% down from the peak just over a week ago, just about 2 weeks ago. So I don't think it sold off much at all. Whereas if we look at the S&P 500 over the same period, I suspect it's sold off more. And certainly the Nasdaq has sold off more. So this is the S&P 500. And if we look over the last few days, it's only down 5%. So I really wouldn't be panicking at this point. If anything, it means you'll be buying at a better price if you buy now. So, yeah. Yeah, let me just switch to my screen. Right. Okay, next question.
I've just added 2 more. So.
Oh, okay. Right. So we've got lots of questions from members. That's good to see. So RM says, I remember your video about the commodity super cycle. Which ETFs in US, Canada would you recommend? How long do super cycles last? Okay, so if it's a super cycle, by definition, it's a long-term trend. So here we're talking about 10 years or 20 years of strong commodity prices. It doesn't mean commodity prices go straight up. Obviously, it means that generally they're drifting upwards over time, probably significantly above inflation. And it'll be specific commodities which do that, usually ones which are growth intensive. So things like copper, for example, is one that's commonly one that goes up because obviously China buys a lot of the copper in the world in terms of global production. About half of the copper goes to China. And if China's growing quickly, then copper prices will rise. We've also seen China buying a lot of agricultural products, wheat, for example, and that's pushed up prices. A lot of people have been interested in uranium recently, the people I've been speaking to in Power Hours. So generally, if there is a pickup in activity, then things like oil will rise as well. We've seen that too. And the energy sector has responded by having some very big price rises. So that's what we mean by commodity super cycle. It lasts a long period of time. And usually there's some kind of macroeconomic force behind it. So urbanization of China or recovery from the pandemic, countries moving to their own supply chains. So the US rebuilding its own supply chains internally, becoming less dependent on China, for example, and vice versa from China. So that a lot of the things which we've seen, which I talked about in that video about the commodity super cycle, are bullish for commodity prices. And then your other part of the question is which ETFs in US, Canada would you recommend? So let's just open up a new tab here and we'll go to ETF DB because I've got a subscription for that and it's pretty good. You don't need a subscription for this, by the way. It's really very good. A lot of this stuff is free. To download some of the stuff, you need to have a membership. Let me just log in very quickly. There we go. So this is, if we go for commodities, so let's say we want to broad, so you can see you've got a huge choice of these. You can go for single commodities, you can go for diversified commodities, and this is what most people generally go for. What I would say is go for something which is cheap. So pay attention to the expenses. So I usually sort by expense ratio. So all of these would be available to you in the US and probably Canada, I'm guessing. Let me just see if that's visible. Yeah, it is. Oh dear, I'm not sharing my screen. Is that right? Sorry about that. So this is ETFDB. This is the diversified funds, which you can see here. The cheapest one is this iPath Gold ETN. It doesn't give you the expense ratio. The cheapest one here is this Aberdeen Standard all commodity strategy. What I would say is if you are choosing between different commodities, between commodity trackers, go for something which has the word enhanced or constant maturity in it, because the difficulty with commodity tracking is that usually the curve is upward sloping. So let me just show you what I mean by that. So if I bring up Zorno, and the curve generally looks like this. Let me share my screen again. And yeah, you can see my screen, good. So this is what the futures curve looks like usually. So the y-axis is price. So this is the price of the commodity future. This is the term of the futures contract. And so let's say we've got the 1 month future, the 2 month, 3 month, 4 month. So let's say that's what the futures curve looks like. and it's kind of upward sloping. So that means that you're continually having to buy this one, the 2-month contract, and you're continually selling this one, which is the 1-month contract. Now the problem with that is you're always having to pay this roll cost. You're buying high, you're selling low. So what you can do is move further out on the curve where it's a little bit flatter. So you buy this one and sell this one, because there the differential in price is smaller. So you can always be clever about which part of the futures curve you buy in order to get exposure to a particular market. So that's what they mean by these enhanced funds. And that's if the curve is going upwards. If the curve's going downwards, you can actually make money on the roll, because then everything will go into kind of reverse. So instead of something like that, if the curve is, instead of being upward sloping, let's say it was downward sloping, well now you're selling this one and buying this one, so you're buying low and selling high. So actually now you want to be at the front end of the curve, because that's usually steeper. So that's the kind of way you enhance your returns with these funds. So if you are going to do it, what I would say is look at things like these enhanced funds. So for example, when it says dynamic commodity strategy, that's what it's doing. It's moving around on the curve so that it's not so expensive, the roll. And this one, it's going on further out on the curve where the curve is flatter so that you're not paying so much for the roll. And this one's a carry strategy, so exactly the same, right? And this enhanced commodity strategy, let's look at that one. This one will actually dynamically move around on the curve. The fee is fairly high, 0.55. But if we go to the fact sheet, you'll actually see how it goes about doing the roll cost optimization. So yeah, not all of these are created equal, and it's worthwhile figuring out how exactly your fund is working in terms of that roll cost optimization. Just make sure it gives you the exposure to the right commodities, and secondly that it's doing something with a curve which you're happy with. And they do tend to be quite expensive, I'd say. Right, next question.
It's a super chat as well. I'll cut and paste it in the stream.
Okay. Barish Palaska says, hey Ramin, Vanguard's bond-heavy funds sold off more compared to stock-heavy ones during the recent interest rate spikes. Is it still a good strategy to increase stock allocation while funds are down, but bonds are dipping relatively more? I mean, you could say, if you just rebalance your portfolio, bonds have fallen, equity has kind of stayed where it was, then you could say, well, the optimal thing to do is to buy the thing which has fallen, which is the bonds, and sell the thing which is expensive, right, which is the equity. So if you're rebalancing, that's what would happen. But if you do have a big proportion of equity in your portfolio, then I'd say, just don't touch it. Just keep the equity in there. And even the bonds, just keep them there. Presumably you've got the bonds there to provide a hedge, which they'll still do, particularly now that yields are higher. If the yield on the 10-year is now 1.5%, you've got more dry powder if equity sells off, for the yield to fall. So, unless the reason for holding bonds has changed, or we're going to get massive inflation, I really wouldn't react too much to these very small movements in the equity market. And in the bond market, the reason for holding bonds hasn't changed. So, which is for the protection in the case of a crash. They still preserve capital. That's the point of the bonds. And yields obviously have risen, but if you look at the size of the sell-off, even for funds like TLT, it's only down about 25%. And it's a very volatile fund because of the long duration. So just bear in mind that it still provides capital protection in the event of an equity market crash. And it's not just one-way flows that we're seeing. So, for example, we saw a lot of buying of TLT yesterday, now that yields have risen and bond prices have fallen. So I really wouldn't react too much to what's going on. Eric Mez says, just tuned, not sure if this has been asked, but what is your view on the housing market? Will a sell-off in the stock bubble bleed into a sell-off of real estate? How does it correlate if it does? Usually the two aren't related. I just did a video on Japan where the two were very clearly related because of the way things were collateralized in Japan at the time. But in the UK, for example, we don't collateralize things with land other than land. You know, you don't collateralize lending to a company based on land prices, usually. So I don't think there's such a tight correlation between land prices, real estate prices, and equity prices. Where there is a strong relationship is with GDP. So if we do see GDP pick up, that's good for house prices. We've seen a very strong support in the UK for the housing market. So they've recently said that if you have a 5% deposit, the government will step in and guarantee the loan. So that's very supportive for house prices up to 600k. So there's very clear policies trying to pump up the housing market in the UK because it's a vote winner. And I suspect in the US, we've also seen house prices increase very rapidly because the people who tend to have done fairly well in this crisis are the ones which have money. Those are the people that buy the stocks. Those are the people that buy the houses. And unfortunately, the very poor people are not the people who buy those assets, unfortunately. So that's why I think even though we still have this very long tail of unemployment, it's fairly positive for house prices. The fact that white-collar workers, educated workers, and the more wealthy have got through this fairly unscathed. So that's a positive for the housing market. I think the bit which is going to be impacted most is the lower end of the market because those are the people in the service economy who buy those houses who have been impacted the most in terms of unemployment and loss of income. So I think the top end of the market will probably do quite well. The bottom end, not so good because we've still got this scarring effect from the pandemic and it's still affecting the service industry.
Someone just super chatted you today.
Okay.
And it's fine, but he said it's for Teddy. So.
Oh, we want a Teddy thing. Right. Okay. Ted, wake up, mate. Right. He's ready. Aren't you, Teddy? So we've got the treats, his special hypoallergenic treats, because otherwise he gets a dodgy tummy. I won't go into details, but it's not pleasant. You're going to stand? Oh, good boy. Very good. You're going to stand up without me? Oh, very good. Oh, what a good boy. There we go. So we're all performing tonight. Okay. Back to questions. VJ says on Super Chat, all talk about asset allocation in terms of percentages. How about fixed amount bond 2-year emerging the rest 2-year emerging the rest stock for 30 years? Any cons? Fixed amount of bonds 2 years, the rest in stock for 30 years. So I think what you're talking about is a fixed monetary amount of bonds and then you just stick the rest in stock. What I do like about that, obviously if you look at asset allocation over the long term, it's best just to put it all into equity. So the bonds you'd put there just for some dry powder in case equity markets fall. And if equity markets fall, then you've got some money which you can invest at lower prices. Unfortunately, the equity component generally rises by more than the bonds. So most of the time it's best to put more in equity. So 100% equity will usually outperform any bond allocation at all, as long as you're kind of happy with the drawdowns, and you can go through the drawdowns without selling. That's the kind of big caveat. So you have to have complete control, complete discipline not to sell if markets fall. But yeah, I mean, that sounds like a sensible strategy, because what will happen over time is the bonds will come to become a decreasing amount of the portfolio as the equity grows. So, after 30 years, you'll have hardly any bonds at all, which is not a bad thing as a percentage, because you'll get good returns that way. So, in fact, it's even another way of looking at it. It's best not to rebalance, because the equity will just keep on getting bigger and bigger and just compound better than the bonds, which have become kind of irrelevant after 30, 40 years. So no, I don't have any issues with that strategy at all. It's quite a sensible one. Okay, back to the questions. Please do like, because it helps us, obviously. Yes, so how many people have we got? We've got 600 people watching. We've got 330 likes, so about half of you still. Let's see if we can get that to 400. It would be great if you liked the stream, because that way more people know that it's good. And if you're watching the replay, also liking would help us a lot. So you're not off the hook, I'm afraid. Okay, and remember, you can always support us. David Kirk, for example, supported us on YouTube just now. It's very easy. You just click on the join button, and there'll also be a link in the description to join and support our independence on YouTube. You'll notice we don't take money from platforms. We don't take money from fund managers. We're completely supported by you, the people who watch us. And that way I can say whatever I like, as long as it's reasonable. But I'm not kind of swayed by the people who pay me to promote a certain product. So that way, we're independent. And I think that's more valuable for you as you watch what we say. Okay. And I should also mention that people do offer to give us money to support their products. Every day, Laura says. Yeah. Oh, Teddy wants another treat. Right, one sec. You're going to get spoilt, aren't you? You're going to get spoilt. Spoilt. Over here. Over here. Over. Oh, that's it. Oh, good boy. Right, back to the questions. 615 viewers. Please do like the stream. It helps us if you do that. We've got 15 minutes to go. And right. So I'll go back to the questions on here. Oh, if you do support us, of course, you get pushed to the front of the queue in terms of questions. Welcome from Level Up Yorkshire. Bit of sarcasm there, Richard. Very good. So JJ says, hi Ramin. Hi JJ. Given how effective markets are at looking into the future, e.g. correctly predicting earnings would bounce back during the pandemic, is it dangerous to not plan for higher inflation now, even though it hasn't risen much yet? 20% of all US dollars in circulation were printed in 2020, true, and the spending boom is about to begin. Okay, so how good are markets at forecasting earnings? Not very, actually. So, I mean, this is Robert Shiller's famous paper from the 80s, right? He was looking at volatility of equity markets. And if you look at the volatility, it's just far too high, given what happens with earnings. Earnings increase for the S&P in a fairly sedate way. There shouldn't be anywhere near as much volatility in equity markets if markets are simply discounting future cash flows. So do markets predict future earnings? Well, not very well, is all I'd say. So I don't think I buy the argument that that's the case. And particularly for inflation, The reason why we're getting all these shocks in the market at the moment is because markets are spooked by a change, right, in the yield. If they could see through that, they could have seen the 1.6% spike, yeah, but they didn't, and people are scared. So I don't think it's true that markets have this kind of magical way of seeing into the future. What is very clear is that markets panic. They overreact to information. When there is a sell-off, then this tends to become self-perpetuating as people panic and money flows out of markets into safe havens. So I think ultimately markets are good at pricing information, but it takes a long time. And that's why when you look at the price to earnings ratio, it fluctuates hugely above and below fair value, because the exuberance and the despair are what kind of drive it away from earnings, the true earnings that we see in markets. That's why I don't buy into the argument that markets are kind of, beard stroking, rational engines. That just doesn't fit with the way markets work. You've just got to look at the price action recently to see that that's the case. But over the long term, markets are very good at figuring out which companies get the best earnings and rewarding those companies and taking capital away from companies which are very bad at providing a service. Yeah. Okay.
Dad just gave us $5.
Oh, Chess Dad, nice to see you again, and thank you very much. That means a lot, and it's lovely to see you again. Nice to see your comments as well. Thank you. Okay. Right. So next question is from Kenneth Adams. Thanks again for these. My pleasure. Scottish mortgage, which is the biggest part of my equity, has suffered badly this week. I bet. Too growth oriented currently. Any value trusts you know of and rate? Thanks. Yeah. So if we look at Scottish mortgage, it had a 14% allocation to Tesla, and it's very similar to ARK, which is Cathie Wood's disruptive fund. So obviously that's not in favour at the moment because of the story about increasing yields in the bond market, and Scottish mortgage is sold off too. So you're asking which things are going to work in this current environment. In fact, the thing which has rallied a lot is small caps in the US. That factor has just shot up over the last month or so, or 2 months. So small caps have done well. Small cap value has done well. So if you look for small cap value funds, unfortunately in the UK we've got very few small cap value funds. If you are looking for particular investment trusts, I don't generally go for those because the fees tend to be fairly high for investment trusts. I'd probably go for a passive fund. So let me just share my screen again so you can see this. If you're based in the UK, Just ETF is probably your best bet. And then you can look at a list by category, and you can look for themes, and then you can look for value. So value ETFs. There are 22 of these. Am I sharing my screen? Yes. And we'll sort by expense ratio. So you can see this MSCI Europe value, 0.15%. USA value tracks the MSCI USA value factor index, 0.2%. Another Europe value. So you can see there are a lot of these MSCI value trackers, both in the US and in Europe, and they're fairly cheap. So as long as you're happy with those two regions, it looks like you've got a fairly good set of choices. Here's an MSCI World Value Factor. And if you want to learn more about the actual index that it's tracking, just Google MSCI World Value Factor. And then you can actually look at, stick a PDF on the end. And these fact sheets from MSCI are just awesome, really good. So this will tell you how it's performed. So since 2006, you can see that value has underperformed fairly atrociously. So historically, the historical returns aren't great. But since 1974, it's actually a little bit better than MSCI World. So that is a recent underperformance. Historically, it's actually done okay, but not hugely better than MSCI World. But if you think this is the dawn of value, again, the rebirth of value, then yeah, you should have a look at one of these indices. And just be sure it's an index you're happy to track. It's got the right region, it's got the right sector composition, and you can always check that, particularly if it's an MSCI one, because they've got these awesome fact sheets. It gives you the country weights, the sector weights, which you can then check out, see if you're okay with that. But investment trusts, pretty expensive. I don't generally go for those. Right.
3 questions in Slack.
Oh, we got 3 questions on Slack, right. Let's switch to that. How long have we got? 9 minutes. Jimmy says, China's vaccination rate is low. Do you think US and Europe will see a supply chain risk if China gets reinfected when the rest of the world opens up? There's always the risk that we get a secondary infection after the mutation happens elsewhere in the world. It goes back to China. Just bear in mind, though, that China is really good at dealing with this virus. Remember how well they locked down and how careful they were. So literally every street had a person who was nominated as a kind of COVID monitor, and they would daily check each of the people in their street to check their temperature, and people were very much on board with the mask wearing, whereas in the West we get kind of uppity about our rights. They're much more compliant when it comes to working together to solve a communal problem. So I think China actually could deal with this incredibly well. We saw New Zealand as well deal with this incredibly well. So really, I think China, even if they do get reinfected, will be able to clamp down on the infection very quickly. So I wouldn't really worry about the Chinese supply chain being affected by that. I'd be more worried about the US and Europe because of the fact there's this kind of boredom with lockdown. There's a strong surge of people who just kind of refuse to do what the government says on principle, which you don't get in China. So I'd be more worried about the US, more worried about Europe and elsewhere. And the other worrying thing is that some emerging market countries will be able to harbour pools of the virus, but they won't have the vaccination. So obviously they'll have herd immunity at some point, but that means there'll be a pool of the virus which can then mutate. So that's the main worry, I'd say. But I think what happens with all these viruses is when it's novel, it's very deadly before we have immunity, but then it just becomes like flu every year. And now we have these mRNA viruses, mRNA vaccines. Those can be adapted very quickly if there's a mutation in one of the surface proteins of the virus. So that's why I'm fairly optimistic that we'll keep it under control, but it's not going to happen immediately, right? So the vaccinations are taking time, particularly in Europe. That's my worry, I think. Barish Palaska says, I thought gold would rise while everything else, markets, bonds, cryptocurrencies, is falling. I couldn't quite observe that. Where is all the money flowing into? Well, remember, money can always flow into cash. I speak to a lot of people about their portfolios, and a lot of them tell me they're heavily in cash at the moment. So obviously gold doesn't do well when interest rates rise. So remember that this is a fairly toxic macroeconomic environment if we do see higher rates, because rates are the kind of nemesis of gold. When you can buy a 10-year treasury and it's paying you 1.6%, gold is paying you nothing, well, then you think, well, that 10 year is more attractive. And if the 10-year bond's paying you 3%, it's much more attractive than gold. So gold is just a wasting asset, and so is Bitcoin, right? So just look at the things which have rallied when we've had zero interest rates. And if things go into reverse, then, it's going to be bad for those assets. So I think, money's maybe flowing into cash. yeah, I think that's probably what's happening for many people. Mohammed Ramin says, which sector is good to invest since the economy is opening up? Well, generally the ones which were most negatively impacted going in and which have taken a long time to recover. So everything which is customer facing has been hit the most and hasn't really recovered yet fully. So cruises, or Carnival. I did speak to someone who'd invested heavily in Carnival. I think it was in April last year, which is probably a bit premature then, but hey, now it's looking pretty good as people go back to normal behavior. Another one is the energy sector. We've seen that bounce back a lot already, but it's probably got more further to go. Then we've also got things like hospitality industry, the restaurant industry, all of the things which we're desperate to do again. Go on holiday, eat out, and socialize with one another. So anything that's based on those kinds of activity will probably have more upside, I'd say. Okay, so we've got 4 minutes. Let's go back. So please do like. It's still not too late. And let's just see where we are in terms of people. Okay. Yeah, so we have 660 people watching. We have 442 likes. Thank you for that. That really means a lot. Remember, you can join us. You can join by just clicking on the join button. That way we get your support and we can stay independent. And we also see a kind of badge next to your name so that we answer your question first. You'll notice that Laura shouts out the names when someone with one of those PensionCraft crowns next to their name asks a question. Okay. So we've got time for one, maybe two questions now. Okay. Okay, so Tricks and Tracks says, hi Ramin, what's the best way to add physical gold to my portfolio? Also, could I ask where your name originates from? It's lovely. Oh, that's very kind of you. So my first name is Ramin, so that's Iranian, Persian. And my middle name is Charles, and that's because my family's from Birmingham. And we've had generations of Charleses going back at least 4 generations that I've managed to track. So that's where the name's from. So physical gold, I mean, the standard funds for gold would be, if you want to buy physical gold, physically replicated tracker, then you'd go for, you can always find these on Just ETF. So let me share my screen again so you can see this. ETF screener by category, and they have commodity ETFs, but the one you want is precious metals. Sort by expense ratio, so you've got the cheapest. So Amundi 0.15%, Invesco 0.15%, iShares 0.15%. So you can see the benefit of competition there. So if you buy some of that fund, they'll go off and buy some physical gold, they'll put it in a vault, and you can literally see iShares, they publish every day how many gold bars they've got in their vaults as people buy more gold. Or if people buy less gold for their fund, they sell the gold bars. So there is a physical gold bar somewhere which is effectively yours. Or you can buy physical gold. Personally, I don't like that because it's a risk. You have to store it. It may be stolen, kind of like a Bitcoin private key. So that's why I don't like it. You have the storage issue, the security issue. So you may have to put it in a safety deposit box or a kind of gold storage facility where you'll have to pay for it. So I don't like physical. Some people tell me they buy sovereigns, but personally, no, I don't do that. So SGLN is another popular one in the UK. But any of these cheap ones would be good. And I can see that there's a lot of competition now, so you can get it for 0.15%, which is very good. Okay, well, it's...
One quick question on Slack.
Oh, okay, one more question. Okay.
You answer it quick.
One of them from RM. what is your portfolio construction like, allocation and funds? So at the moment, Vanguard very kindly uh, uh, they put an end to the fund I was invested in, which was my only equity allocation. It was in minimum volatility, their minimum volatility factor fund. So that's now cash. So that means I've only got long duration UK gilts, which is about 40% of my portfolio, and a sterling hedged US Treasury fund. So either of those have probably lost quite a bit. Am I going to sell them? No. And I've got some cash in that fund because the equity thing was sold. So no equity at all. But I will start to buy more equity, particularly if markets carry on selling off and valuations become more reasonable. But I mean, also, my personal circumstances, I was fairly unsure about what would happen with the revenue from PensionCraft. So I had to be very cautious because I couldn't really afford to have a big capital loss. So, I've achieved those gains, but I sold my equity in February, half of it last year, just before the sell-off. More luck than judgment. So I'm kind of cash and bonds, right? No equity at all. But don't do what I do. That's what I always say. And I firmly believe you shouldn't copy other people. You should learn about how to invest, use your own research to decide how you invest. And most of the time, it's best to have as much equity as possible. So don't do what I do. Do what is best for you. Okay, so let's end it there. And thank you all for joining us. It's incredibly humbling to see how many people have joined us tonight and liked the stream. Please do like it if you haven't already. Remember, you can join us on YouTube and you just click on the join button. If you join us on Patreon, you get to join our Slack channel where Laura was posting some of those comments. But it's very lively now, the discussion we have. I'm fascinated by some of the discussions which people have. People help each other a lot. It's a friendly community. We try to ensure that's the case. We do police it. We don't really need to, but we do. And you also get lots of members only content. So we produce a video every week, which is only for our Patreon supporters. And there's a big library of those now and growing every week, obviously. So thank you for joining us. Thank you for joining us for the live stream. I hope you have a great 2 weeks. Don't panic about markets. Stick to your plan. And I hope your portfolios do really well. So see you in 2 weeks' time.